So the Fed's worst nightmare, a 35% stock market crash, is potential for 2025. So the last time that this doomsday scenario played out for the Fed was back in the beginning of 2022. So you could see this is a chart of the Nasdaq, and we peaked out right here January 3rd of 2022. But just a few months later, not even a year later, the market fell very sharply, down over 35% in under 1 year. So what caused this crash? Why did the Nasdaq go down 35%? And what is similar right now that we could learn from to maybe understand, well, maybe this is going to happen again? This video is going to break all this down for you because honestly, there's a lot of people that are worried right now. So the Federal Reserve has two jobs. Number one is to keep inflation low, right around 2% as their target. And number two is to keep the economy ripping higher. But there's a problem because when you do one thing, it often makes the other thing worse off. So they want to basically make both things go where they want them to go. But it's often like when you want to make the economy go good by cutting interest rates, you're going to make inflation get totally out of control.
My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people.
So they're essentially walking this tightrope right now of trying to keep the economy strong, but not trying to make the economy too strong that it creates inflation and makes the inflation rate go higher. So they're trying to make this balance work out. But there is problems with this, and it's kind of playing out just like 2022. So let's break down what was happening in 2022, why the stock market went down, and why there's a very, very similar scenario playing out right now that could potentially crash the stock market all over again. So everything that we're going to talk about here is going to come back to what interest rates actually are. The Federal Reserve uses interest rates as a tool to either try to bring inflation up or to bring inflation down, or to try to stimulate the economy or to try to make the economy slow down also. So right now we're in this pinch where the economy is slowing down, but inflation is showing signs of ticking up a little bit. So the Federal Reserve is now torn between which one do we focus on more, the economy or inflation. So let's take a look at what happened at the end of 2021 where inflation started to get completely out of control and see what the Fed focused on. Because remember, they could focus on the economy, they could focus on inflation, or they could try to focus on both. But in this scenario right here where inflation got out of control, the Federal Reserve did not focus on two things. They only focused on one thing. And the thing that they focused on, the stock market did not like it. So this is a chart of the Consumer Price Index, which is just the headline inflation number that comes out every single month. And you could see inflation got totally out of control, ripping all the way up to 9%. And then it came down, which right now we're at 2.4% for May. But we're still above the Fed's target of 2%. So just by looking at this, yeah, it went way up and it came way down. We're pretty close to target, which is good. I agree with you. But there are problems right now, and Jerome Powell, who's in charge of the Fed, he's talking about how the June and the July CPI data that comes out is probably going to be a little bit hot because the tariff stuff that's happening in the economy right now, it's going to be realized in those two CPI inflation reports. So yes, the trend is clearly down, but what if Jerome Powell is right, which honestly he probably is right, because I'm in the camp that, he's the Fed. He has access to data that we don't have access to. He sees this data before it actually comes out officially. So he is very persistent that inflation is going to tick higher for the next few reports. And if that becomes a trend, if the inflation expectations become unanchored, which is what he talks about all the time, if people expect inflation to go higher, it probably will go higher because think about it. Like if you want to go buy this water bottle at the store, if you think inflation is going to come back, are you going to buy this water bottle right now or are you going to wait 6 months to go buy it? Kind of like applies to cars better than a water bottle, but you get my point. You're going to want to go buy it right now because you're scared that it's going to be way more expensive a year down the road. So when there's more demand to go buy something, the price of that certain thing is going to go up. So that again, that is inflationary too. And that's exactly what Jerome Powell is worried about at a time that Trump just sent out as I'm recording this video. He said we're probably not going to be able to make a deal with Japan, a trade deal with Japan. And there's many other countries that we're simply not going to be able to make a trade deal with also. So what Trump's plan is as of recording this video, which it changes all the time, but he's essentially saying, look, we're going to write you a letter saying that we didn't make a trade deal and that's okay. But if you want to deal with us, if you want to shop in America, as Trump talks about, you are going to pay us a flat 20, 30, 40% tariff, whatever it's going to be. So when that happens, when we take these goods and we import them into America, there's going to be that tariff. And when there's that tariff, inflation will go higher. So flipping back to this inflation chart, which one did the Fed focus on? Was it the economy or was it inflation? They focused on inflation because look at the next chart. So this chart shows you the federal funds effective rate, which is just essentially what is the Fed's interest rate at? So in that similar time period, December of 2021 coming into January of 2022, interest rates were pretty much at 0%. But remember, inflation spiked up really high, and look what the Fed did with interest rates. It went higher and higher and higher and higher and higher, and it went all the way up to 5.3%, from 0 to 5.3%, to try to bring this inflation curve down right here, which it did come down pretty drastically. But there was a problem with that, and there was a cost. The cost was we bring inflation down at the cost of the stock market, at the cost of the labor market, at the cost of the economy, at the cost of people paying 7% for a mortgage or paying 10% for a car interest rate. Just interest rates went way up, so the economy slowed down. And when that happened, like we talked about earlier, the stock market went down over 35% in that same time period when the Fed was raising interest rates. So the bottom of the market was right here around December of 2022. And if we go to this chart right here, you could see 2022, this is 2023 right here in the middle. We go to the top. This is right where inflation started to break and inflation started to go down. And the reason why the bottom of the market was actually at the worst possible inflation time is because the Federal Reserve was signaling that we're starting to see inflation progress and interest rates are going to come down. So now you could see how critical interest rates really are for the stock market. So now to really bring this back and cover why you came to this video of this potential for a 35% stock market crash. There's a lot of fears with Jerome Powell, with people at the Fed, with financial analysts, with financial experts, which I get it, most of them are idiots. But again, Jerome Powell has access to data that we don't have access to. Jerome Powell is saying he's expecting inflation to tick higher right here. But the problem with that is that means interest rates are probably going to be higher for longer. I'm not saying that we're going to raise interest rates. Like right now, we cut a little bit and we're sitting here at 4.3%. But the market is pricing in interest rate cuts. So as the market's expecting cuts, but maybe we don't get them, or in a weird chance that we actually get interest rate hikes, the stock market is not going to like that. So at a time that the NASDAQ did this super sharp dip and already rebounded back to all-time highs, the market is pretty much pricing in perfection right now. We need inflation to stay low. We need interest rates to keep trending down. We need corporate profits to keep ticking higher. And we need this AI and tech revolution to keep chugging along just fine. Because market valuations, they're not exactly cheap right now. That's a huge problem. So we've all heard the saying, don't count your chickens before they hatch. But that is exactly what we're doing in the stock market right now. We are counting all of our chickens before they hatch. If they all hatch, the stock market's going to be just fine. But if they don't all hatch, the stock market will correct 35% at a minimum. So right now we have to worry about a few things. We have to worry about the economy, we have to worry about inflation, we have to worry about tariffs, and we have to worry about elevated valuations. So on this chart, we're going to cover the valuation super quick. And I know we talked about this chart on this channel before, but it just updated and it just hit a new all-time high to show that valuations are actually worse than what we think. So let me explain super quick. So the red line corresponds to the S&P 500 and the blue lines correspond to a price earnings ratio level that the S&P 500 will be trading at if it was on top of that blue line. So let me explain. So like coming out of 2008 financial crisis, we were trading at roughly a 10 price earnings ratio level. And coming into the dot-com crash, we were right around 25. And if you're wondering why you should care about the price earnings ratio level, it is one of my favorite single metrics to value the stock market. And of course, it's just one single metric, so it's not the end all be all. But if you were to look at one chart and say the market's expensive or the market is cheap, this chart is going to be the one that tells you that. Notice how the stock market did when it was trading at this higher valuation level in 1999. Market went down, wasn't good. Notice what happened up here when the Federal Reserve had to raise interest rates to try to bring inflation down, which we talked about in this video. The stock market came down. In a similar time period right now, what do we expect the future returns to be? Because we're trading at a valuation level that we haven't even seen here. We haven't seen here. We haven't seen here. We haven't seen it since 1999 for how lofty the stock market is right now. Maybe all the chickens hatch like we talked about, but maybe they don't. And in the world of investing, you do not want to count all your chickens before they hatch. That is insanity, because if you do this long enough, there's going to be edge case scenarios that play out and that they happen that come out of left field that no one is really looking for. And that's going to happen and you're going to get wiped out. And where is my card? Here it is. You need to be prepared for a 35% stock market crash. And I am by no means guaranteeing you that we're going to see that 35% stock market crash, but I am just saying valuations are a little bit rich. Inflation might tick a little bit higher. The Fed might have to keep interest rates higher for longer, and we have to worry about tariffs, so that might bring inflation higher. There's things happening right now that are big needle movers for the stock market. I'm not here to scare you. I'm not here to flip on Mr. Bear, Brandon, whatever you want to call me. I am extremely bullish. I think the stock market's going to rip higher going into the future. I just think that 2025 and 2026 is going to be very, very volatile. But that is amazing that we get volatility because volatility equals opportunity. Volatility is not risk. I am pretty much bullishly allocated with everything I'm doing right now. Like today, for example, I just collected $10,000 by selling puts on a company that I feel like is cheap. So there are still deals out there. There still is money to be made on the bullish side. I'm just keeping my ratios in check. I'm not over leveraged, especially with options right now, because the chance of a downside correction is starting to build as the market gets more expensive. And I want to be ready to capitalize. I want to be prepared for a 35% stock market crash if we get it, because I want to be able to capitalize and have the buying power to do it so that when we rebound out of that dip, I'm going to be in a very, very, very good position. You make your money in the bear markets, you make your money in the crashes, and the markets that we're in, like right now, like in the last 3 months since April 8th on the low, I think my account, my main Schwab account, went up like over $300,000. Like that is how you capitalize on these dips. But if you were over leveraged at a time that the market was expensive before that dip happened, you weren't able to capitalize on that dip. So right now, don't have too much option exposure. Don't be over leveraged. Keep your emotions in check. I am extremely bullish on the stock market in the long term, like 3 years plus. Very, very, very bullish. I'm just saying 2025 and 2026 is going to be bumpy. I'm not saying I'm bearish. I just think it's going to be bumpy. So I'm just saying to be careful out there. But if you're worried about the stock market right now, if you're getting emotional, if you're getting FOMO, if you're starting to panic, you have to watch this video right here. I cover all the emotional aspects of investing. And if you lost money in the market before, which we all have, you have to watch that video from start to finish. It's crazy if you don't. So check out that video and don't forget for the next couple days, my course and my Discord is 100% free. You're going to lock in and learn everything I know about investing in the stock market and stock options, how I scaled to millions, how other people like you scaled to millions. Check it out. See you guys there.